what you're seeing is a rolling over like we're seeing in the rest of the country. So let's look at...
We're hitting a new all-time high in Nashville for number of people employed.
The silver tsunami is not something that we can argue with. I mean, this is happening.
The population of 35 to 45-year-olds is only growing for the next 10 years. The silver tsunami is going to be...
Ethan? We're not having
It's bigger than the baby boomers.
Right? So Bessent also said he wanted the tenure down. He hasn't gotten that. Hasn't affected it. What
That's
they've
not
done
true
is...
also.
Excuse me?
That's not true. These are minuscule numbers compared to our overall housing market.
How much was the subprime market in 2008? You are going to have a correction of, 35 to 50% depending on where you are.
This week I spent 2 hours with Melody Wright. Now, if you don't know her, she made national headlines predicting a 50% housing market crash. Now, I come from a completely different perspective, but I couldn't help but wanting to have a conversation and just ask her questions about why and how she believes what she believes. This conversation went in directions I didn't expect. I thoroughly enjoyed it. It was an authentic conversation with someone with a completely different viewpoint. I hope that when you comment, you can have the same respect that we have for each other. Disagree vehemently on the facts and the perspectives, but hold a respect for the individual. And if you like these, click the like button, give me feedback. It's been challenging, thought-provoking. I'm still thinking about it. And with that, here's the conversation. You're from Johnson City, or you live in Johnson City. I'm from Johnson City. We've got the hometown.
That's funny.
I feel like in 2023, we were totally in line with where we thought the housing market was going. And since then, we've kind of diverted. Mm-hmm. I couldn't agree more about it. Just felt so fake. The accumulation or the lack of inventory. One of the most compelling charts that I had seen in a while. I kind of want to talk about what we agree on first before we kind of divert into what we like, why we maybe disagree. And maybe you can help me understand what I'm missing. But in 2022, there was this zero inventory on the market. Prices skyrocketed. One of the most rapid appreciations happened in the housing market in the spring of 2022. 2-week supply in Nashville. I remember thinking it felt fake. I was like, this is just weird.
Right.
Since then, we've seen a massive increase in supply. Prices dropped when there was only 2 weeks. Like prices were going down and there was no inventory on the market, which was paradoxical. Mm-hmm. Fast forward though, inventory is like 10 times what it was then. It's grown. But prices, when you look at median, prices are flat. And I say flat. In Tennessee, they're flat. In Nashville, I would say we're just teetering on the all-time high. It's always just right there. Mm-hmm. When we look at like Zillow, which I think normalizes for a little bit of where home value direction is, maybe from a seller's perspective versus a buyer's perspective, they are saying home values have dropped maybe a few %, but nothing dramatic.
In Nashville.
In Nashville.
Yeah.
In aggregate, right? In aggregate, we're seeing home prices drop 10 and 20% in neighborhoods. Like we've seen, like I helped a buyer. They closed in December. They bought a house that sold in June of 2024 for $810,000. They bought it for $636,000. Wow. The seller had to write a massive check. The seller actually wrote a bigger check than my buyer's down payment to sell the house.
Sorry, I don't mean to laugh. That's
well, I mean,
bad.
it's just like, it's crazy.
Yeah.
No, I mean, it's crazy, right? It's just like, It's crazy. So it's not that I don't see it, but when we look in aggregate, it just seems like everything that I'm measuring, there's no like real collapse.
You mean
in prices.
like national aggregate is what you're...
Well, even in Nashville, even as I'm seeing these crazy price drops, I would say that that's not the broad experience of most people. Most of my buyers don't feel even, that buyer obviously felt pretty good because they got a house that dropped 20% value in a year. But most people don't feel like prices are just, as buyers, they don't feel like they're just getting,
I don't think they will for a long time, Ethan. I mean, that's the problem when you have such a mismatch between the median income and, the median home price. they're not going to feel like it's a good deal for a very long time. For these to match, I say match, when they go back to their historical relationship, and when you think about what the percentage is that you're going to pay for your house every month, you are going to have a correction of 35 to 50% depending on where you are. And so they're not going to feel like it's a deal for a very long time, in my opinion.
Well,
go ahead.
I wanted to ask you about that. So when what's the formula for the median income? Or you've mentioned that a lot, and that was one of my questions. What's the formula, and then how do you extrapolate that to local areas?
Well, sure. So the formula is, I don't mean to be, it's pretty simple. It's
make it simple. I keep it simple. So please.
Yeah. Firstly, you can look at the historical relationship. I don't have that chart up right now. I could get it up. You look at the historical relationship really before the 70s, it kind of started changing in the 70s. Like they just tracked. It was all about what you could afford and I'll speak to that. So what can you afford? Like you can go to the website of the FDIC. You can go to the website of even Fannie Mae, which is ironic. And we can talk about why. And they're all going to tell you that you should not be paying more than 27 to 31% of your income, your take home pay for housing. And anytime that you do, trouble starts. And so like you can look at the Fannie Mae debt to income right now. It's showing 38, which is about the same that we saw. Like you can go back to 2008. That was the only time it was that high again. And so, and this is after we've all talked about such a change in credit quality, which we can obviously talk about. I come from mortgage. I can tell you what's actually happened. And so that's the relationship. So I'm looking at both. What should it be from just a general, over time, how much should you be paying for housing to not be cost burden? And then what was that historical relationship and what happened? And again, in the 70s, it wasn't a massive move. You could just started, you were just like this for the longest time. And then it just kind of started gradually going up, which is when women joined the workforce. As they joined the workforce, you had an increase in divorce, which obviously increased household formation because, people that were living together had to go find housing. And then when it really started to get out of control was really the late 80s when you kind of had the S&L crisis, when we started thinking about housing as investment versus housing as shelter. And that just got completely out of whack when you had so many investors coming in. 30% of the market during this last cycle at certain points. And so it wasn't about affordability. And a lot of that buying was either for long-term rental or short-term rental, long-term rental because people were like, well, you can't afford a house. So, long-term rental is a great bet. But unfortunately, as we're seeing now with Apartment List, it just came out and, Vacancy is the highest they've ever seen in their series. They started tracking in 2017 and rents are coming down because people can now no longer afford those rents either that were, so you had that appreciation. So really 30% is what you should be looking at in terms of what you're paying for shelter costs. And right now, we've got people paying 50%, and that's just untenable.
So you would say it's 30%, and you would say that's a monthly payment. And am I right in saying that? Like,
if you make that way, yeah.
If you make $3,000, you should be making a monthly payment of $1,000. Is that? Yeah, I guess that's 33%.
And honestly, I think 28%. If you want to get really specific, but yes, that's basically right of your take-home pay.
So what about the increasing number of people that are all cash? It's 40% of the market is all cash, no mortgage.
And so all cash and no mortgage. Let's be clear.
Sure.
Okay, so no mortgage that we know of, Ethan. So here's the problem. Private credit has gotten cute and has gotten into this market and is giving all kinds of home equity like products without actually reporting those to credit. But yeah, sure. So no mortgage. That's, A lot of those are investors. A lot of those, I mean, if you're just a regular homeowner, that sounds great. But when you get a property tax bill in the mail that is much higher than you're used to, a property insurance bill that's, I had one of my servicers run a calculation. And since 2020, insurance has increased. They're the third largest servicer, 50% across their entire book, as well as electricity costs going up, replacement costs going up. And so it doesn't matter if their mortgage is paid off, especially if they're on a fixed income, because a lot of those mortgages that are paid off are the boomers. And they,
Sure.
they're retiring. They're not going to be increasing their income. And so you're seeing a lot of people, it's starting in Florida, but you're seeing a lot of people have to leave because they can't afford, and they had a fixed income and they didn't think that, they'd see those kind of increases. And you're hearing more and more. Just Google any city that and just property tax, and you'll see people storming city council meetings like, I feel like I'm paying a mortgage. These property taxes are insane. So, I mean, we're very lucky here in Tennessee, obviously. Yeah.
Are prices are going down in Johnson City, right? Would you say, or no?
Well, yeah. Oh, yeah. I mean,
it seems soft there. I mean, I pay attention to that market.
Yeah.
That market actually felt more overpriced to me than Nashville.
Well,
because I see my mom's house, and I'm not trying to dig dog on my mom's house, but I was like, Mom, your house shouldn't be $500,000 years old.
Such a good example.
$500,000.
Yeah, Ethan, it's such a good example because, I think it was a year ago, 2 years ago, they were rated as the top 4 place to move to by one of these crazy studies or whatever.
It's the best. I love Johnson City.
I mean, I love it. Problem is, there aren't any jobs. Problem is, sure, it's the best if you're from California and you want to come. Yeah. But by the way, they hate it here. I talked to so many. It's like, there's nothing to do compared to what they are used to. And, so sure, if you're coming from somewhere else, but for people that live here, they can't afford these. And I'm watching it every day, Ethan. I'm watching these houses. I'm watching price cuts. But yeah, it's totally overvalued. But Nashville, we'll see. It's
and this is where I'm a little bit more skeptical. Yeah. So I wanted to show you this chart. This is Zillow's chart of affordability. They're saying that if you put a 10% down, you're at about 38% of your income on average for the United States. And does this look reasonable to you? I mean, does this look, or do you think this is far-fetched? Because I feel like, go ahead.
Well, what do you mean by reasonable? That they're saying affordability has improved by this much? Is that what you're?
Yeah.
Well, I don't think that, that's fine. It's still not matching reality. And so when most of the people that were actually transacting in the marketplace were either investors. So you kind of had 3 classes. You had investors, you had boomers that were helping their kids. And then you had government subprime, which was FHA, which was supporting prices as well. So, Ethan, that's great, but has that made any difference to home sales?
Home sales are flat. There's no doubt. And here's Nashville. Nashville's still at 42%. So Nashville's very high relative to the income. Yeah. The reason I'm asking this question is because I think that the narrative among some of the most bearish people looking in the housing market is that prices have to come down. It can't be solved any other way. And that's where maybe I have a hard time with this piece of it, because prices are basically flat. I would say nobody feels like prices are falling. They've fallen some in some neighborhoods. I don't want to dismiss that, but I don't think buyers feel like prices have really fallen. No. Maybe sellers do, but buyers don't.
Yeah, they've been watching mainstream media.
Right. But this is, it was October of 22. It was insane. It's 51%. It's dropped dramatically without prices really moving in aggregate.
Sales not moving either. When you have but
they've been the same for the past. They're 20 for a single family home.
Right.
It's 28,000 houses a year versus maybe a 33 to 37,000. So you're talking about 5 to 10,000 sales missing every year from Nashville's housing market for the past 3 years.
So
Which
why
I
are
agree.
they going
I
up?
agree with you.
Why aren't they going up? So here, Ethan, so where we're probably going to differ a lot is
Yeah.
that I look very far ahead and I look at all these factors, right? I'm not really as interested. I look at what's happened in the past so I can understand my thesis for the future. But
Okay.
if this was such a significant drop, then you would have had increased home sales. And so either affordability is not the issue in your market, or this isn't enough, because where we were at
It's
the
not
peak,
enough.
right? Where we were. So here's what Realtor, not Melody Wright, says. Realtor.com just came out with an article that said there's 3 ways that you're going to be able to help affordability.
Okay.
1, you can drop rates to 2.65%, which I would actually say, I don't know that's going to do it completely, because you have such a high rejection rate right now on purchases and refi applications. So I think you might even have to go lower on those rates to truly help affordability. The second thing they say is that wages would have to rise over 50%, which I would love if it wouldn't cause inflation. And then the third thing they say, and this is not Melody Wright, this is Realtor.com, they say prices have to correct by 35%. So if you're going to juice this market, so, I mean, we are looking at sales that are the lowest. And so we can look at this tiny snapshot. We can, like going back to 1999, we just had the worst November except for 2008 on an aggregate basis, not a national.
You're talking about in national,
No,
worst,
nationally. Yep. And
yeah,
so for Nashville, for me, Ethan, like having been there now 3 times touring that city, and it was the first city I stopped on in my tour, we're still not seeing the inventory. It still hasn't made its all the way to the MLS. And there's various reasons for that. I think that in this cycle, there's a lot more private note actors, private note buyers that are transacting outside the MLS. And so there's a lot going on that we're not even seeing. But then it's also partly the builders who absolutely are not listing all of their inventory, which is, I mean, you can go to any one of these new build subdivisions and see that.
Yeah. Well, it's interesting. New builds are losing market share in Nashville. I mean, Nashville, this is what's interesting about Nashville. Transactions are flat. You're not wrong. They're not going up. They're flat. They've been flat for 3 years. New builds starting this year lost major market share. So new builds
are 25, sorry.
2025, yes.
Okay.
New builds, I'm going off the top of my head, but this is directionally correct. They went from, let's say, 9,000 or 8,000 units a year, which is roughly 25%, down to 7. So they lost about 1,000 sales. So it was 10 to 20% they lost in terms of sales versus previous year. Existing homes made up the difference in that.
Yeah.
And see, I'm seeing buyers pass on new builds that builders are offering incentives. They're offering lower prices. And I'm like, why don't you just buy a new build? And they don't want to buy a new build. The lots are small. They're concerned about quality. And sometimes the locations are out there. So in fact, and so I would agree. I actually think new builds have a major problem that we're not talking about, but I don't feel like a new build way out in Columbia or Spring Hill. I think there's high risk. I mean, there are some FHA. Couldn't agree more with you about the FHA risk out there. But why would that impact the entire housing market when it feels like it's pockets of the housing market and not necessarily the whole thing?
Well, it's no, so the way it's going to impact, and probably what you're seeing is law of diminishing returns, Ethan. I mean, back in 23, when I toured the perimeter of Nashville, like I was absolutely blown away. Only Nashville takes second place to Austin, but so it's already what I think the impact of those new builds have already happened in Nashville and a lot of the cities across the Sun Belt is that they've kind of hollowed out already who they're going to bring out to the suburbs. And in fact, what you're seeing in a lot of these places is they brought somebody out to the suburbs who now wants to get back in the suburb. I mean, get back into the more closer to the city and they can afford it because they're finding some sort of deal. That's not a huge population. But I think there's a point where the new builds stop becoming an option as existing home inventory grows. And I think there's going to be this, push and pull between those two things. But I don't, nationally speaking, the new builds are impacting prices. I mean, absolutely. And this is, we were missing almost 3 months of data now. So we don't actually know what's going on with the new builds. We have no idea.
Where are we missing 3 months of data?
Because the census hasn't published. That's who does the, and Ethan, I hear from a lot of people that they don't enter new home sales in the MLS. And so
I've tried to fact check that.
These are realtors that have told me this.
Yeah, it's hit or miss. You look at Davidson County. So Davidson County is the urban core of Nashville. It's the most populous county in Middle Tennessee, probably in Tennessee. Maybe Shelby's bigger, but Davidson County, every time I've checked this, about 20% of transactions don't transact on the MLS. So we're talking about single family home purchases, 20%. And on one hand, that's a lot, right? That's a ton. On the other hand, it doesn't appear to be increasing. Now, the where I'm watching it, and I'm very interested, is, Compass is now becoming this behemoth, and they're doing a lot of private exclusives, and some of those don't make it on the MLS. And so I would say builder behavior, it's not that they don't transact on the MLS, it's that their behavior hasn't changed. So if they're not transacting, they're consistently not transacting. And so it doesn't necessarily change the narrative, in my view.
Well, if you don't have any view on what those prices are doing, I mean, it matters. And so here's the thing: if somebody really wants a home and they can't afford that median price in Nashville, and in Nashville you have Nashville proper, you have a lot of very rich neighborhoods that aren't necessarily going to be impacted by, what's happening to the middle and the bottom of the K. But if you have somebody who really wants to buy a home, that's what they'll do. And they'll deal with the stupid commute while Nashville proper stays frozen because people haven't realized how much inventory is there. And also, so this may be different, or maybe you track this as well, but you've got to look at the rental inventory, the build for rent, the multifamily that has been built in Nashville. The fact that you have what's your owner occupancy in Nashville? I think it's probably in the 40s.
For single family? I don't know. I don't know. That's a great question.
I'll look it up while we're talking, but you have, I believe it's a pretty low compared to the national average owner occupancy in Nashville, which means that what you actually have is a landlord class, more so than kind of it's Joe and Jane transacting everywhere. And so as these investors start losing more money on holding this real estate because of that insurance, because of those replacement costs. And have you guys seen what we've seen here in Johnson City with electricity costs going up? We have gotten hammered here.
They raise them every year. I haven't heard any buyer or customer. I've heard complaints in the past about the water. The water's been a little bit of I don't want to call it a scam. I try to be nice, but they do these things where if you water your grass, then they increase the cost. That's the first I've heard about complaints about. I've seen headlines, but nobody's raised that as an issue.
Do you focus on all of Nashville or what's your typical client makeup?
Typically people reach out to me when they want somebody more so that does math and less so that does home tours. I'm not that great at telling somebody the quality of their countertop. If they want to just benchmark it, think through it, look at repeat sales, appreciation, try to think through it multiple different ways, rent to mortgage payment ratios, which even if you're not an investor or you're not planning to rent it, knowing what the market's willing to pay monthly for your house is way more important to help you understand how overvalued your house might be at the current point. I had a conversation this morning with someone who putting 20% down on their house would have been about a $4,300 monthly payment. That's HOA, taxes, insurance. And I told him, I said, well, this will rent for $3,600 to $4,000 a month. Now, that still seems out of whack, which I told him is still a little overpriced, but that is so much better than where it was 2-3 years ago, which is crazy. So what we're seeing, in my opinion, single family rents have been strong. Apartment rents are a disaster, but single family rents, they've stayed up. It's starting to make more sense today than it's made in a long, long time for a lot of these houses. And this is where I go back to the income ratio. I don't disagree.
Sorry. Can we go back to the one you said their mortgage payment was going to be what? You said $4,300. And the rent they could get is $3,600 a month. $3,600
to $4,000. I would say $3,600 is low, but yeah.
So you told him that makes absolutely no sense, right? They're not going to.
I told him it was overpriced, overvalued to the monthly. Does it not make sense? I've backed off on saying that for a few reasons. One, I'm watching the market change dramatically without prices changing dramatically in a lot of neighborhoods. Two, when people are renting, especially when they have families.
Sorry, like can you describe what you mean by watching it change? Sorry,
yeah, no, that's great. So 5 years ago, this is Zillow data. We're looking in Nashville. Zillow data is saying that in November of 2020, the typical income was $71,000. Today, they would say it's $93,365.
And home prices have gone by how much during that time?
I want to get to home prices in a minute, but looking at the income, I mean, they've gone up insane. And so not just home prices, let's use income needed. So the income needed in 2020, which I think kind of normalizes that, was $70,000. And let me share my screen so I'm not. Okay. So, and it was in balance there in 2020. Okay. Today, if we use the same metric though, income has gone up 30% in 5 years. Income's gone up 30% in 5 years. In another 5 years, because I'm listening to our president talk about his plan to devalue our currency, why would we not expect income over 5 years to go up a similar amount? And if it did go up a similar amount, where would home prices be in terms of the income to payment ratio that you mentioned?
Let's slow down.
Yeah, please.
So we're saying 28% is what, that's actually how incomes have risen. Median income. That's not even income though. That's what's needed to afford a home.
The blue line is what's needed to afford a home.
Right.
So it's still way, there's still a big gap here, right?
Okay. So even if somehow incomes had risen by that much, home prices rose by how much in Nashville from 2020?
I mean, I don't know specifically from 2020. I mean, it's like 40%. I mean, it's so 40, 50%
more than incomes have. But 100%. Let's take your second statement, which we are seeing moderate wage growth. But we're also seeing one of the highest unemployment rate we've ever seen for our youngest cohorts, and very high for kind of that 25 to 30. And we're also talking about AI take jobs. I guess I'm confused why we would think that income would raise that much over the next 5 years.
Well, I think that any break in so we're at a point in the labor market where no data is showing us that it's breaking. It's bad, it's soft, whatever you want to call it. But the data, 4.4% unemployment, and
But you know what that measures, right?
50,000 jobs added.
Right. They were expecting 60. But what is U3?
Yeah, I mean, it's small. It's very anemic.
The reason
I don't want to debate it's a strong job market. I'll give you it's not great. I don't think it's collapsing, but it's not great. Maybe it will. Maybe we'll get the collapse, but it's not in data yet.
What was the private percentage? What's the percentage that payrolls increased in Nashville last year? Private payrolls.
I would say 5 to 6%, but I do not know that off the top of my. I don't think that's been released yet. Do you know? If you can look it up.
Yeah, I doubt that's it. Like we can.
Look it up.
BLS.
That'd be great.
Sorry, but what we're seeing all over the country is that private payrolls are not increasing. You're seeing increases in education and health services. You were seeing some increases in government. That's gone away. So I
have seen continuing claims drop in Nashville. We've seen some big layoffs.
But why does that? Why do you think that? And because it's very different this cycle than last cycle. Why do you think that's happening?
I would say because people are employed again. You tell me, educate me, Melody.
They're doing gig economy work. And so you can go look at what Tennessee pays out. And Macro Edge does a great chart of this by state of what you can make doing Uber, doing DoorDash. That's going to be a better option than, getting unemployment.
Yeah.
Let me finish this thought on labor. So right now, you are at 1.7% increase, 12 months year over year, in terms of just total jobs.
Do you want to share your screen? You're welcome to if you want to.
Sure. Okay, so this is just from Bureau BLS, Bureau of Labor.
Yeah. This is great. Yeah.
Yeah. So
this is actually. I'm glad you pulled this up.
Yeah, 1.7%. So where you're seeing strength, so you've got.
But we see an all-time high in employment. So we're hitting a new all-time high in Nashville for number of people employed.
No, it's 1.7% in a 12-month period. Yeah. So you're not. So at this point, you're not seeing. What you're seeing is a rolling over, like we're seeing in the rest of the country. So let's look at, okay, so 2.5% education health services. These are not private payrolls. This is what you're seeing out in Minneapolis. A lot of this fraud, a lot of these government programs, a lot of which are running out. I'm not sure what the Nashville budget situation is right now. I haven't looked in some time. You're seeing an increase in leisure and hospitality. Small category, other services, and you're still seeing a little bit of government. Most people are not, like most places, but your mining's down, your information, very minimal growth here. In fact, it's been off and on negative. So and you're a big healthcare hub, right?
Healthcare, technology, finance.
Yeah. So, you would expect to see quite a bit of, and this is the thing. What I think people don't realize, Ethan, one of the things that it really was it was like a lessons learned is like the economy can't keep going on just like this. It has to grow. And so seeing that growth year over year, I mean, that's what we see in the aggregate for the numbers we're seeing right now. Is what we'd expect. But it has to continue to grow in order to keep that economy chugging along. And so what you're seeing all over the country is kind of a rolling over of the categories where you get the most incomes. But let me show you something else. Let me go to my latest Substack if I have it up. When we're in these turning points, I think that you have to look at alternative data to understand what's going, especially with the things like we didn't have the gig economy before, not in the way that we do. I mean, this was a big, post GFC kind of thing. And so let's talk about.
But don't you think that keeps things from falling apart? The fact that people could just flip a switch and make some money to make ends meet while they're trying to go and find another job. Don't you think that's different? Like if you have a house and you're going to lose it, you can turn it into a hotel. We've never been able to do that before.
But you can't. But doesn't mean you're going to get occupancy. What is the occupancy trend for Airbnb right now in Nashville? What's the occupancy trend?
I don't know. I'm super bearish on Airbnbs. One, because they're competing with hotels and hotels are increasing. You also have more Airbnbs. People love a money losing Airbnb that they can write off on their taxes. It makes no sense to me. But if I'm struggling to make ends meet, it's never been easier to rent out a room. It's never been easier to rent it out for a weekend. It's never been easier to have alternate options to kind of hold things together, which I think is what you're saying.
Yeah, if you have renters, and which is one of the reasons why it's held up as long as it has, Ethan. The problem is we're starting to see tourism come down. We're definitely
are we seeing it come down?
Yes.
Can you show me like where? How do you know it's coming down?
The aggregate numbers. I don't have them up right now. But
I do follow the tax receipts, hotel tax receipts. It's flat to slightly negative. So I would say it's flat, not down.
Well, in certain areas, yeah, okay. I'm talking more nationally, and so I have not looked specifically at Nashville tourism, but I can tell you nationally it is down. But let's look at this, so I think what you said is exactly right. It's why we've seen things sustain, because people who had options took those options. They did DoorDash, they did Uber, they did short-term rental. They tried to do maybe rent out a home. They've consolidated households, which is why you're seeing vacancy rates go up in multifamily. But my point is they're running out of those options, and we're not adding jobs at a clip needed to actually employ those people again. People are dropping out of the workforce, and there comes a point where the Uber drivers are competing with one another. And we're seeing this already in Airbnb. They're competing, but this is something. So we are now looking at the most Americans working part-time jobs that we've ever seen. And since in 2008, in November 2008, compared to now, that's what this is showing you. But yes, we increased population. We increased population by 12%. We increased the number of workers doing these part-time jobs by 30%. And so you've got more people doing everything they can to make ends meet. And there comes a point where it's not enough. There's nothing they can do, especially as these programs like the FHA, those are running out. And we're seeing that delinquency uptick significantly now that program has run out. You've had a lot of things intervening in the market to keep it propped up. And those things are starting to run out. Unless we get jobs, and this is what I look at, okay, what are the jobs coming to Nashville? What's coming? What will increase those jobs? Because Ethan, for a healthcare hub, what are the headwinds you have? Right now you have the headwinds of the Medicaid cuts. And those are going to be massive. And it's not like, that Medicaid cut just impacts, Susie in a wheelchair. No, these impact these massive healthcare providers. My sister in Knoxville, she's a physician, and she works at a kind of comprehensive wellness center that serves the underserved. And they're freaking out. They're not going to have any funding. And so, these things are that's a big headwind for Nashville because it's coming. And you also see that government jobs, I think those will be going away based on some of these other, in this thing that Trump is doing on cutting federal funding because of fraud. There's fraud everywhere in the system. And so I guarantee you that stuff is a little.
I'm not disputing that.
So my point is what's coming. So Nashville, and I 100% believe that Tennessee is going to be a destination for a very long time, especially for retirees. We just have too much, going for us in terms of low taxes. For me, but I'm different than a Californian. Quality of life. Like I like my life in Tennessee. A lot of the Californians don't like it because they don't like the politics and they don't like things like that.
That's not been my experience, by the way. Every Californian I know that's moved here feels like they've made it to freedom.
Heaven.
They love it.
I'm not going to argue with Tennessee being heaven. Like, I'm not, but
it's the best.
I can tell you with some of the folks that I've talked to, that's not how they feel. But I still think it's going to be a big destination, especially for our retirees. All these people that are going to flee Boston now because double-digit property tax increases, second year. I mean, we're going to see that. But so going back to that owner occupancy, Nashville's owner occupancy is 53%. The national average is 65%. So you're not talking about you and me buying a home. You're talking about landlords and what landlords are going to do. And landlords are majority boomers. Our youngest boomer right now is 62 years old. And so the older ones are either they're going to, where they're landlording, they're going to sell those homes, or they're going to leave them to their children. And Charles Schwab, did a study and showed 70% of homes that are inherited get sold because the kids don't want it. In our case, a lot of times they can't afford it. And so, what I would do in a market like Nashville, because there's a lot of narrative, the counties that you're focused on, that's probably it's a higher median income, I think, in Williamson.
It is.
Yeah.
And so it is.
What I would, if I were in that situation, because I hear this a lot, Ethan, if people are like, well, my neighbor, I mean, it's the nicest neighborhood. That's true. Go look on Property Radar. Tell me how many of those homes have delinquent property taxes. They may not be delinquent on their mortgages yet, but they're delinquent on their property taxes. And how many of them have owner liens, and how many of them have deceased and they're in probate?
I mean, you say that. Do you have that data? Yeah. I just feel like I don't know. I don't want to be quick. I don't want to be too quick to dismiss it. I am very skeptical, but maybe you can educate me.
Well, I mean, I'm never a skeptic about something I haven't seen. I'm just curious, right? And so,
yeah, but that's just because most people, there's a lot of, especially owners that don't have an escrow for their
it's not escrow
property tax.
Ethan, if you can't afford your property tax, you can't afford your property tax.
No. I'm saying most people that don't pay it in their monthly payment is what I'm trying to say. Sometimes they'll be delayed on it just because it's a bill that, goes in the pile, and there's no real process to pay it once a year.
Well, so here's where I'm just going to have to use my experience.
Use it.
I'm from mortgage, and I have managed default, and that's the mortgage folks are always going to be current on their property taxes because the servicer has to advance them.
Yeah.
If
right.
They are escrowed, if they're escrowed. But let's say, so Nashville proper, you've got tax delinquent of about 7,000 fully delinquent of the 100. So I'm looking at, this is the owner occupied. So anyway, these are real problems. Like these are.
Can you see how it's changed versus the previous year or something? Is there a way to trend?
I mean, I can certainly try to bring that.
I think that would help. If I saw a trend of skyrocketing, sometimes you talk about that with delinquencies. That would be interesting.
Yeah, but it's just one other thing when you're looking at a market to see its true health. Look deep. See what's actually going. And the other thing is vacancy. I can tell you on my road here, I have 6 properties in the 2 miles coming out to the farm that are vacant. And there's a lot of that in Nashville where people bought fix and flips, but weren't able to afford to finish them, or they just aren't getting the rent they want, or somebody's died. It's in probate. They're not at the point that they want to. So whether these things have changed over time, they're just important. And when you're looking at a market to see a more like holistic picture of what's actually happening, especially in these very pricey markets where, you see a lot of boats and RVs and you see a lot of this stuff. But what you don't realize is that they're over leveraged, and it doesn't have to be on a mortgage. It's because so many people take out these personal loans.
But this is maybe the core of where I think we diverge in our thinking. I agree with you. There's a lot of over leverage. I don't disagree with that. Where I disagree is I feel like we are in a cycle similar to the 70s and 80s where our currency is being devalued so rapidly that it's a deleveraging cycle, right? But it's not coming at defaults. It's coming in a wave of bailouts. Why did housing not crash in 2020? My point in saying that is in 2020, yeah, when nobody was working, why didn't housing crash then?
Oh, because firstly, interest rates went to the floor and everybody did a cash out refi. And they also got a mortgage forbearance. They got a mortgage forbearance for 18 months. They didn't have to make 18 months of payment.
But why can't they do that today?
Because they aren't getting a mortgage forbearance anymore. Those programs are gone.
But do you not think that if labor breaks, that they would pull all of the tricks out of the bag that they used last time, including
not if they don't want to be
sending stimulus checks
on the rails with they'll send the stimulus checks. That's not what did it. What again, this market's not about the little people. The investors got low leverage. They took out loans, or they went to a hedge fund who said, hey, I'm going to go buy up a whole bunch of homes for long-term rental or short-term rental. And that hedge fund said, here you go. Here's a facility that you can use to buy those homes. And they went in and the reason why you had 2 weeks of supply back then is that was investor participation. Ivy Zellman talked a lot about that back then. It was moving so fast, we couldn't actually see what was transacting. And so these hedge funds gave all these folks, these fix and flippers, they gave them a lot of leverage. It's not a mortgage. It's a loan from a private credit institution. And they went out and they bought these homes and they often securitized them in these private securitizations. And so they kept the market sustained. Meanwhile, Joe and Jane were getting a mortgage forbearance. They didn't have to make their payments. And so what will happen now, because people are mad, Ethan, they've learned about this FHA program. They've learned about these eviction moratoriums. They've learned about the mortgage forbearance, and it will not be politically palatable no matter what, because the youth who does not have
I don't think it's politically palatable now.
Well, right.
I think it's outrageous.
So they won't be able to do it. They may try to. So just like
but why will they not be able to do it? Why you keep saying that? They won't be able to. Why not? Why can't they do it?
Because it's not politically palatable. They're not going to suspend payments for 18 months.
No, they hand out checks to everybody.
$2,000 ain't going to do crap. It didn't do crap back then. The PPP is what did crap. These private credit who went and backed these investors.
There were JPEGs of monkeys selling for $1 million.
FHA, exactly. FHA, which said you don't need a down payment. Okay, we say 3.5%, but really there's a down payment assistance program. You can go get those funds there. You come right on in, is what they said. And that is staying in the market.
But you say it's not political. I think they're backed up against a wall. So I don't disagree with you that it's not politically palatable. Maybe I have a different definition of that. But their choices are, you can crash assets, which they have decided that's not the route they want to take.
Are you so sure?
Yes, Trump completely flipped from being an asset crasher. Yeah. Right. In April of 25, I was like, oh, okay. He's going to cut government spending and he's going to crash assets and we'll get affordability back in the market. If you'd have polled me then, I would have said, hey, I think this is actually going to make things more affordable for people in Nashville. Today, I am
absolutely convinced he wants to. If you follow the rhetoric of him and Scott Bessent, the rhetoric changed from not being worried about asset crashes to we're just going to have to grow our way out. The last statement that sticks with me from Trump is him saying just this last month that he doesn't understand why we can't see 25% annual growth in 1 year.
At the same time.
And that will come in the form of wages.
Yeah, but
and I don't.
Ethan,
I mean,
hold on. Like, let me finish my sentence.
Okay, go
please.
ahead.
Look at what they've done. Not what they've said. They've said a whole bunch of things.
They're holding up assets. That's what they're doing.
So Bessent, no, they put the guardrails on that FHA program, and that's going to have a material impact. It's already in the delinquency for November and December. We just got the numbers. The serious delinquency is skyrocketing. That is 13% of the market. That's what subprime was. It's
13% FHA, 13%.
Yes,
of FHAs
overall market.
Right. And of the FHAs that are.
Hold on. Let me speak to your points.
Okay.
You said Bessent so Bessent also said he wanted the 10-year down. He hasn't gotten that. Hasn't affected it. So they've said a lot of things. What they've done is, also. Excuse me?
That's not true. It was 5%. The 10-year was 5% in October of 23. It's between 4 and 4.25 right now.
Yeah, Bessent wasn't in power in 23, Ethan.
Well, I'm just saying it's been trending down for 2 years.
But he said on January, they said coming in the administration, they were going to get that down.
It's lower than it was when they came in.
By how much? Pull it right now. I've got it up, actually.
Yeah, I'm looking.
My point is, they've said a lot of stuff.
In January 13th, 2025, it was 4.8.
Sure. But it's not materially down. He wanted it materially down. And it's been sitting at that 4%, 4.2. They want it materially down. But here's the thing. They don't control the bond markets. Also, what they have done is put the guardrails on that FHA program. That's one thing they did.
But okay, go ahead.
So the second thing is, and that's going to have so I can say what I've got to, as a politician, I've got my boomers yelling at me over here. I've got my youth yelling at me over here. I have to walk a very fine line, which walk the line. I'm sure, Johnny Cash. So, and at the same time, if they really wanted to not let home prices come down, they wouldn't have put those guardrails on the FHA program. And then secondly,
that's not true. Can we talk about the FHA and then you go to your second point?
If you want to, but I don't feel like at this point.
well, you said FHA is 13% of the total mortgages. Okay. Yeah. But first of all, there's only 60% of the market are mortgaged. Okay. There's a 40% of households that don't have mortgages. So of the 60%, 15%. And how has that
trended over time, Ethan?
I would say more towards
what are the facts?
Mortgages.
How is that trended over time?
I don't have that. I just know that 40% aren't mortgaged right now, 60% are.
So how many were in 2008?
Hang on, 13% of FHA loans. So there's about 8 million of FHA loans. Okay. That's 13%. Okay. Of those 8 million, only about 2 million have originated since interest rates spiked. So only about a quarter of the FHA loans have come since the spike in interest rates in 2022. So now we're talking about 2 million.
What does that matter?
Because you have, like John Comiskey saying, there's a risk here. 250,000 could default, but these are minuscule numbers compared to our overall housing market.
How much was the subprime market in 2008? What was the percentage?
They will impact specific neighborhoods. And in 2008, there was way more going on than just the subprime.
Sure. There's way more going on right now.
My point is that the market, I spent a lot of time talking with John Comiskey about this. And I do think he's understating the risk in FHA. Actually, I do think he's understating it. It's still very, very small, and it's for very outlier neighborhoods. These are new build neighborhoods that are far from...
that are underwater, Ethan. It's not small. It's all over the country. It's not.
It is.
So the ones
Well,
that are, yes, the ones that are underwater right now are in
Mhm.
Texas and Florida, majority, but hold on. Okay.
Okay.
This matters. It matters that subprime was 13% of the market back then. This is what's going on. You also have credit scores were inflated. So the prime books are not in what the condition everybody thinks, and we're starting to see weakness there. But again, that's mortgage. This is the problem I think that a lot of people have is they want to put to one reason. But what we've done is we've gone through about 5 or more headwinds, and they're converging just as things converged in the last cycle.
But they're converging with a government committed to holding asset prices up.
Look at
Stocks
what
are
they
at
do.
all-time high. Gold is at an all-time high. Housing, it is crashing in Florida and Texas and parts of
in California.
There are parts that are crashing. They are not going to let a nationwide crash happen. They have stated that. Trump has said that.
Politicians have to say a lot of stuff. Politicians.
But it's not, you're right. It's not what they say. It's what they're doing. Exactly. And what I see they're doing is fake low interest rates. They're forcing interest rates lower than where they should be. We see asset prices inflating. The Fed just started QE. And I'm looking at all that and I'm saying, and he's saying, I want to grow my way out of this by stimulating incomes. They are focused on real income growth.
And how do you get that? How do you get that?
You don't tighten things. They're not tightening things. They're not tightening finances, monetary policy, even the FHA program. It's a drop in the bucket, in my opinion.
Well, it's not a drop. No, it's not a drop in the bucket, but that doesn't matter. I mean, it is just one of the things that we're facing. But let me show you. So a lot of people are talking about this $200 billion they're going to buy. So they've been buying since May. They've bought about $47 billion, Fannie and Freddie. Okay. It has not helped sales at all. I'm hoping we're having a little bit of a stronger December. But let's take a look at history and let's look at what happened when the Fed started buying during the GFC. Okay. So this is the Case-Shiller. This is Fed buying MBS. Okay. These things work sometimes. Sometimes they don't work. Here is the 30-year mortgage rate back then during that same time period. Here's Case-Shiller. You see that mortgage rate coming down until we get to the little refi boomlet in 2010. Okay.
Do you know when transaction volume picked up?
Transaction volume? Not until 2012, 2011, 2012. So, November of 2008 was the worst sales we saw for any November since 1999.
Well, you cannot use November as a benchmark. That is
no. I can show
that
you.
Is a very.
I got it. Of course not.
I know,
I'm giving you a data point. I can show you combined sales as well. Combined sales, they did not pick up until really a little bit in 2011, and then 2012 when the institutionals came in to buy, is really when you started to see transactions come off the floor. But they didn't get back to norms until even later than that. And so my point is they can take a lot of action. They can say they want that 10-year below 4. They haven't been able to do it. The bond market decides on that. They're going to buy this MBS, which they've been doing since May. And in fact, when the Fed bought $700 billion of MBS in 21, up to the point where they raised rates in 22, mortgage rates actually increased. And so politicians and officials can say whatever they want to, but it doesn't mean that the market is going to agree. And in terms of show me a plan of how you're going to increase income and not increase inflation, which is there's a reason why.
Well, I think it could be nominal. I think it could be nominal. Why does it have to? It could increase inflation and income at the same time. Why couldn't it?
Well, because
It probably will, right?
Yeah. Well, if they get there, and Ethan, where are your thoughts then on AI?
AI has presented us with more opportunity in our lifetime that we could ever imagine. Any individual right now can build something on their own. I worked in finance and FP&A, which I think you did too.
Mm-hmm.
I worked for a corporation, and I had to spend time with the product department explaining what we needed to build. And it was so bureaucratic. And it was, some technologist or product person that didn't understand finance building it. Today, I can build that and say, here's what I want to build. And you just need to take my vibe coding and go and put the security rails around it. And I think it's going to completely change productivity. So SG&A as a class is going to continue shrinking. I mean, technology companies are going to lay off or reduce hiring because they just don't need as many.
So what jobs are we going to be working?
There are an infinite number of problems that need to be solved that can be solved with technology, with individual contributors that can now create these products that.
So should we be expecting a product from you soon?
My whole website has been vibe coding. Yeah, I think I created one of the best real estate visualization tools you can get, and I built it with AI. But
because that's existing visualization. It's very good.
What do you mean? No, it's not existing visualization.
Oh, really? So, okay.
Yeah, I built all these visualizations. Here, I'm going to show you. Let me show you my site.
Because the visualization has already been built somewhere else.
No, I built this. The data, it was somewhere else. Nobody has built this. There's not one person in the universe that's built a map that looks like this.
Does it look exactly like your map? Of course not, because it's going to have different colors. It's going to be arranged differently. But what are you doing? Are you taking the FIPS code and the zip code, which you can get?
I individually drew these.
I don't know why you would do that, because there's existing technology that you can get for free right now.
You can't. There are certain neighborhoods that you can't do that, but you're not wrong. There are other ways to do it. I chose to do this way. The point is that you can't get this anywhere else. And I built this using Claude and ChatGPT. This is the best data visualization. You can analyze the shift in neighborhoods. Sylvan Park, where I used to live. You can see what the active listings were a year ago. I don't know anywhere where you can go into the neighborhood and literally see what active listings were by, for the past 3 years compared to contract volume.
Parcel does it.
Parcel.
There's a
first
lot
of all,
aggregators that are doing that.
First of all, Parcel doesn't do it. They don't do this. I would love to see it if they do.
Listen, I think claiming that you're doing something that no one else is doing, when I can tell you could go get a tool like this for free and create
show
like
it to me.
This. Yeah,
of course you can. But people with AI can build things. Of course,
you've created an individualized version of this. That's great. That's not transformative. That is something you could do with anything. I was building a short-term rental technology.
You can do it with anything. Just pick what you're trying to do, and you can do it with AI now.
Well,
that's like saying I could have never built a website.
Maybe
and even if it is someone else,
you could. Yeah. You could have gone and gotten researched these free tools that exist with this mapping tool that's free out there, open source. You could have taught yourself how to implement that. Yeah, you could have. My point is, it's already one of the reasons why what AI is good at is creating things very similar to what's already been created. And that's my point. But what I'm saying, you're saying it can solve problems. How is it going to solve the income problem specifically?
That's how wealth is built, is you solve a problem that people are willing to pay for. That's how you build. You solve a problem that people are willing to pay for it, and they pay you for it, and you do it for more than it costs you.
Okay, so you think that what'll happen as everybody's losing their jobs with AI, what's going to happen is everybody's going to become entrepreneurs and create a product different than everybody else, and they're going to be able to make a living wage, and it's not going to be a product just like yours.
I mean, they can create one like mine.
Maybe, but then that's competition for you.
That's right. That's great. That's what, and then I have to figure out how to do it better. That's capitalism.
Sure,
I've got to figure out how to do it better. The most value for
100%. But how is that going to grow income? And how many entrepreneurs do we have today? How many people are built to be that kind of entrepreneur? So how is that going to impact the labor market? That's my question at scale. Mm-hmm. And so that
let's start with the companies. First, you have companies that are now, there's two things that I think are going on with companies. One is they're now able to produce what products or services they've been doing with fewer people. Okay. That's what you're talking about, right? That's labor layoff. Okay. That's less
according
jobs.
To MIT, it's not that many, but yeah. I mean, if you believe in it, it's going to be a few. Mm-hmm.
I think it's a lot. So you can do a lot more with less people. Now, those fewer people are then free to go do something else, right? And there are some people that are having a hard time with what that looks like. But I'll tell you one of the things that I think, let's just talk about medical. The Medical Association restricts the number of doctors. There are plenty of medical needs. Why are we restricting the number of doctors? Shouldn't we be cutting the cost of education and empowering people to go into areas that we need people in to reduce the costs? I mean, there's plenty of areas where we need skilled people in this country that we do not have.
Sure. It's skilled people for sure.
Mm-hmm.
So, but the problem is, what we haven't talked about here is the accuracy. And so I've personally trained these models. I've worked with them. The accuracy is not great. I don't know if you've QC'd your website. I'm sure you have, but I can tell you that,
always test it.
But I can tell you that at this point, we don't have accurate models. And it takes work and money. And recently, I just took an example like Salesforce, who has an AI agent platform that they were selling as fully automated. They've since backed up and said, okay, actually, you're going to need coders, developers to manage the system because you get so many false returns. Also, it just wasn't working. It wasn't doing what it's supposed to. Like Vivint, they was using it to try and send out customer service satisfaction surveys after every client interaction, which is easily programmed in a workflow tool. It couldn't even do that. And so,
but I think you're dismissing AI as
I'm not dismissing it. Okay. You can believe in the technology and its promise, which I do, but how that's going to be implemented in these corporations that don't really pay for research and development anymore. How that's going to be implemented and truly productive, that's what I'm waiting to see because I haven't seen it yet. And the studies that have come out is that, you can go ask Apollo. You don't have to believe me as well. And they're showing companies aren't seeing those productivity returns. But if you're a believer in AI, that's what I find so fascinating by also believing that we're going to increase wages so significantly. And so Absolutely. My question is, how are we going to do that?
How are we going to increase wages? Well, I think let's talk nominal and not real wages, because that's, I think, the simplest way for my small brain to think about it. They're going to keep interest rates lower than where they should be. So the 10-year treasury, which we're all talking about, there's not much control on. They can control the supply of debt issued. They can control, there's a lot of levers they can pull to push or put pressure on it downward. And outright buying. They can outright buy the 10-year bond if they wanted to, which is what they're doing with mortgages.
And Japan can sell.
Okay. But you're right. But who cares, right? Then we just don't have to pay them back. and they just print it and buy it and then just say, nope, we're never going to pay that back. So
what do you mean?
I mean, so
They'll
let's say
sell it to somebody.
China puts $1 trillion on the market, says, oh, we're going to push up the 10-year. And then the US goes, oh, we're going to print $1 trillion and just buy the 10-year. No,
who's going to be
cares?
buying the 10-year if they're doing that?
They'll be the only buyer. They don't care. I mean, at the end of the day, if you think in extremes, like they obviously don't want to say that. They don't want to.
What do you think the yields are going to do when they're the only buyer?
They're going to be low. They're going to be fake.
They can't buy that much.
They're already. Do you realize right now?
And they're not below 4.
Melody, do you realize right now you can borrow? Sorry. Yeah. Listen, I'm excited about this point. You can borrow for 30 years at a fixed rate for less than the deficit that the US is running to GDP. We are literally printing more money and pumping it into the economy as a percentage of our GDP, and you can borrow at a 30-year fixed rate for less than that.
Why are sales so low, Ethan?
It's fake. It's a fake low rate. It will pump the economy. It's fake.
Wow.
And you'll see inflation. You'll see asset inflation. You'll eventually see wage inflation. If it's just asset inflation, they'll just hand checks out to people. They will figure out a way to pump this into wages.
Well,
and I don't think there's any reason not to think that wages won't be 25% higher 5 years from now than they are today.
So you think they were just more stupid during the GFC? They didn't figure it out? Because they did a lot of printing.
I think they did
a lot of buying of mortgage-backed securities.
They were more afraid. No, they were more afraid of inflation. They didn't do stimulus checks. They didn't go directly to the people. They just inflated assets.
And stimulus checks aren't going to do jack crap. $2,000. What did it was PPP. That's what did it. ERC, PPP, idle loans. All of that
it was
money.
all kind. They did. They just printed it and handed it out to people. I don't know why. Know why you think they won't do that again. They're not going to let
of the blowback. So my second point that we never got to.
Sorry, thank you.
Just wait. Okay. All of this fraud and abuse, they're stopping federal funding. Okay. That's what they're doing to Minnesota. And they're not going to stop there. And a lot of these municipalities absolutely rely on that federal funding. And so it is going to have this is something else they're doing right now. Okay. So when I say, look at what they're doing, not what they say. And if I'm Trump,
they're not cutting spending. Even if they cut Minnesota, they're still spending more. They're taking that money and handing it out to somebody else.
What are they going to spend it on?
They're spending it on all kinds of things. A $1.5 trillion defense budget. I mean, what's that going to do to Alabama's housing market?
Exactly. On defense. But how many of us work in defense right now? How many people are trained to work in defense right now? How many people who don't have a job will be able to work in defense in the future? That's where all the money is going to be going.
But you're pretending like $1.5 trillion in defense wouldn't impact other areas. And that's just simply not true.
I'm not pretending. I'm not saying that at all. I'm just saying even that it's not going to be so sorry, I just looked up 10-year was at 4.57 on 1/2/2025, not 4.8. I just pulled this from Fred, just so we're clear. No, I'm not saying, but this is not going to be an overnight panacea. People are going to have to get trained up for this. And so they can be increasing these jobs in defense.
Here we go. 4.8.
I'm using
1 year
Fred.
ago.
Use Fred. Okay. Anyway, so I think that what you're talking about is a lot of intervention that we don't know what the actual result will be. Just like there was a lot of intervention last time, and they did just about everything they could, except to your point. Well, sorry, we did have direct stimulus like after 2001, we did after 9/11. So my roommate got a big check. So it's not that it hasn't been tried before. They've tried a lot of things before. But here's the thing. So you can argue with all of that and what's going to happen with the labor market. But the silver tsunami is not something that we can argue with. I mean, this is happening.
I spent some time with Eric Finnegan, who's the demographer for John Burns. He said the population of 35 to 45-year-olds is only growing for the next 10 years. That generation is okay. So this is the silver tsunami is going to be.
Ethan? We're not having
it's bigger. It's bigger than the baby boomers.
Right? No, in terms of it will be bigger because of the mismatch when they're all dying off. But and how much? And so look at Harvard did a study about how much household formation we pulled forward during COVID and how much demand. And I'll pull that up for you while we're talking. It'll show you from the millennials how much demand we can, especially if immigration is being stopped, that's the only population growth we had last year. So, and actually the year before that. And so you have to look at that. You can't look at like, this is what industry insiders do is they say some stat like that. They don't talk about it in a historical context. And so it's more than the boomers. Okay, well, what does that mean historically? Was it more than the boomers at that age cohort? No. And so, and what has happened to so what we're seeing right now is household formation for the first time in a very long time.
Share your screen.
Yeah, I'm getting this story up. I'm just talking while I'm getting it up. But household formation, where it was going, basically, you were seeing household size get lower and lower and lower. That has stopped because people are consolidating because they can't afford to buy a home. They can't afford to rent. They're moving their parents in with them. And so this is household formation. If I am 35 to 40 years old and I'm living in my parents' basement and I don't have a job, I'm not going to be able to buy a house. And so let me try and get this up on the fly, but it is a great graph.
Well, listen, I don't dispute what you're going to show me. And I actually don't dispute the idea that there's more housing units per population than we've ever had. Now, I think it's important to recognize that. Where I may disagree on those stats is that we've turned a significant chunk of our houses into Airbnbs, hotels. Mm-hmm. We've shifted structurally what we need in our houses, whether it be office or whatnot. People spend more time at home. And so it's not that there's not more units. In fact, that's one of the things that Eric said, which I really respect him. He said, listen, there's going to be what feels like a depression in some areas as demographic shifts take hold. And so I don't want to completely dismiss the demographic argument, but he did say that the population of home buyers over the next 10 years is going to be larger than the population, the boomer population fading away. And he also said that really what you need to pay attention to is regional migrational shifts and demographic shifts.
100%. But
so
you said earlier in this conversation that hotels were going to be competing. You've got new hotel growth in Nashville, and they're going to be competing with those short-term rentals. What do you think is going to happen in those short-term rentals?
Those things are going to zero. There are going to be houses that get, look at Detroit, and this is extreme, I think, in extreme sometimes, but you look at Detroit, they've been bulldozing houses for 10 years.
Oh, yeah.
Those houses went to zero is what happened.
100%.
Those are housing units that never sold, that just went to zero. They're getting bulldozed. And so when we think about home prices, there are going to be houses in this real estate cycle that are completely useless. I think there's a lot of cabins in Gatlinburg that are going to get bulldozed. They're not useful. They don't make money. They don't make sense.
So what do you think that does to home prices?
Well, I think that what we find is that the homes that people want are still hard to find. They're still hard to find. And so buyers as a group continue to end up spending more, even as sellers as a group are getting less for their homes. And what I mean by that is that, again, if you look at Zillow, they say home values are declining. In Tennessee, it's not much, which, by the way, I would welcome. I mean, I don't think anybody wants unaffordability. I I would welcome it. I would welcome home prices dropping double digits. It wouldn't bother me in the least. I think it would make it a lot more easy. The conversation we had this morning would have been easier, right? Mm-hmm. But those make real estate highly local. Those make real estate as an asset class not really moving, even as you see, Lance Lambert posts that chart where you can see, Florida's getting wrecked and the Northeast is going up. Why is the Northeast going up? It's not like their population sky
and not.
Their population slowing. Is
it's slowing because it's delusion and it's narrative. And that's what I mean by you've got to look at. Well,
but if you were home buying up there, you would think, if you tried to buy a home, you wouldn't be able to find the one you were looking for, and it would be more expensive than what had been selling. I think the buyer experience it is more experience, whether the narrative is there or not. They're just trying to buy a home and they're like, well, I have to pay more or I can't buy it.
Because the seller is deluded.
Well, they're not deluded if they can get it, though.
They're not getting it. Everything you're saying, sales are at a low.
They're 20% lower than where they were. They're 20% lower.
That's massive.
That is massive, but that means 80% of sales are still happening. That's also massive. That's 4 times more massive.
What are you talking about, Ethan?
I'm saying
increased population by 20% since 2008. So that's not even accurate. You've got to look at what we've increased population. You can't look and just say, oh, they're 20%. No, that's so relatively speaking, look, this is what I'm trying to say is like, it's not one or two things. Anybody that looks at the housing market in aggregate, I think is crazy. You have to look at the local markets, which is why I look at 85. It's why I've driven all over this country, including to Nashville, to see what is going on the ground. But what happens in these big cycles, just as it did last time, is that the regional narrative shifts from the national narrative. And the Northeast at the moment, they have been in a cycle of they're older. It's an older demographic there. There's very low owner occupancy in Boston, New York, et cetera. And so they're doing just fine. That's starting to shift. You take somewhere like Boston, they've had double-digit property tax increases 2 years in a row. Their owner occupancy is like 30-something%. Those landlords are going to be getting out, as well as they're going to be, unfortunately, dying. I hate that, but that's what's going to happen. And your millennial that wants to buy that home at the moment cannot buy that home. They can't afford it. And so this is all about how quickly can wages increase. And by the way, I want to see wages increase. I want to see more people participating in the labor market. I want to see our 6 million missing men from the labor market back in, out of the basements, not playing video games anymore. I want people feeling good that they can make a living wage and they can afford a home. And I would love to see wages increase. Right now, I don't see them doing anything that would make that happen. And if you believe the AI narrative, you have a massive headwind to that at the same time that you've got a big homeowner asset population that is going to be dying off. And so there are a lot of policy things they can try. They always try a lot of things. They tried a crap ton during the Depression. They tried everything. The only thing that finally got us out of the Depression was getting ready for war, which I think a lot of people argue is what we're doing right now. What we did down in Venezuela was about those rare earth minerals that you need for weapons. Getting into defense. We're not all trained for defense. So if that's where we're going to need to go get jobs, then there's going to be some time that it takes. But by the way, if we're all going to have, we're going to have robots and AI, will they even need us for those jobs? Because a lot of the factories that are the auto factories, all these big factories are run by robots. So I guess until I see a plan, I'm going off the things that have been done. And the only thing that's really been done to housing No matter what they've said, 50-year mortgage, we're going to kick the institutionals out. We're going to buy mortgage-backed securities. And they're doing that, but it hasn't done a flipping thing for sales. And yeah, we had some craziness in the MBS market, which of course we're going to have on Friday when you get an announcement like that. Rates went all the way down to 5.99. They went back up to 6.06, which the low we got last year was actually 6.08. And so we're actually where we were last year. That's where we are. And they've already bought as of December.
That was the low. That was the low of last year. They've been dropping for the last 12 months consistently.
Yeah, but that was the low of last year. We never reached. That was the low, I think, in October. And we've never reached that this year. And so we're finally at the low of last year. And they've bought $50 billion. So.
Well, yeah. I mean, yeah, we were a year ago, January 13th quarter, Mortgage News Daily, 7.25. Now we're at 601. It's today, 601. So
well,
that's
I use MBS Live dashboard and we're at 6.06.
Sure.
But look at what, since they've been buying, that it has come down for sure. Absolutely. And mortgage rates, no doubt, but it hasn't helped sales. And that's what I want to see.
Well, and I do think there's a headwind to, as mortgage rates trend down, typically people don't jump back in because they're getting paid. Like if you're a buyer, every day that goes by that mortgage rates are going down, your purchasing power is going up. It's cheaper to wait every single day. So I do think there's a short-term psychological question mark that would play out in a 90-day period. You'd almost have to roll it every 90 days to see. And that's part of maybe one of the questions I have that I don't have an answer to, but is it possible that all these Trump announcements are slowing what people are doing so that they can get an idea of what tools they'll have in the next 60, 90 days? They're going to make an announcement here another week. I don't know the answer to that.
If it were me, and I would say maybe, but but that's, we've just had these announcements. Like this was literally Friday. This has nothing.
Yeah, but they've been teasing like, oh, we're gonna declare a housing emergency. We're gonna do like the portable mortgage. These are like they've been throwing out some very big ideas that would completely change how your buying experience or selling experience would be. And that's very disruptive to an average person thinking about whether or not to buy or sell. I
don't disagree. I don't disagree.
So I'm not, my personal thought, like what I'm expecting is that demand does end up going up because of where rates are, but I'm open to, to me, it's like wherever the data goes, it goes.
Right. Same here. Honest to God, I'm just calling balls and strikes at this point. It's like, what's happening? And what do I see with the oncoming supply? For sure. And so I've found the one, this is the one, I'll share this with you.
Yeah, please.
There's another one they recently did as well that shows you without immigration how much worse this actually looks. What they're saying is U.S. household growth surged in 2019 to 21. This was household formation. But here's the projected rate that they see.
Can you zoom in just a hair if you're able to? If not, no worries. Yeah, that's awesome. Thanks.
Right.
Very surge. Household growth surged.
Yeah, this is, it surged. It came, we were seeing, this is because all of a sudden, people were getting that PPP. Yeah. And honestly, they could take their $2,000 and maybe go, rent a house for a down payment. But so the projected rate is lower. And this is what people aren't taking into consideration. And then there's another version of this chart that I'm not going to be able to find in time where it shows you the immigration and the impact that has with immigration slowing. And whether you want to agree or not, personally, I didn't think that there was a lot of I-10 lending. I didn't. Then I find out that there's a whole bunch of shops that are doing just that. And then, John Burns puts out its schedule and says 6% of FHA purchases were, they were foreign born. And so this has an impact. Maybe it gets turned around in a few years, but this is a massive impact that not only are they not, so it has an impact everywhere. It has an impact on hotels in New York because they were living in hotels. It has an impact in Chicago because they were getting $15,000 in rental assistance. It's going to have Chicago. We're one of the only places that's got sustained rent increase right now, but that's going to be impacted soon because people aren't getting that money anymore. And so, there are a ton of things happening right now, and we have to keep it all in context. And so I don't give a, what, that he's telling me they're going to grow incomes by XYZ. I need to see the proof in the pudding and how that's going to happen. And because what I'm seeing right now is they're buying MBS. They've been doing it since May.
I would say they're doing it at a slower pace, but maybe I'm wrong.
Even if you take that. So again, let's take a look at how much you want. I can show you again the chart where the Fed was buying trillions and it didn't make an impact. And in fact, like I said, from 21, yes, I just showed you on the back during the last cycle. So
you're telling me that the Fed bought trillions of mortgage-backed securities and it didn't make an impact?
$1 trillion. So I'll show you. We were just looking at that chart.
No, but I'm curious about you saying it didn't make an impact. You're telling me you don't think it made an impact.
So while I'm getting that chart back up, April 21 or 21, January 21, till the date they started raising rates in 22, March of 2022, mortgage rates rose. They bought $700 billion in mortgage-backed securities during that time, and rates rose.
What were the dates you said again?
January 21 till when they started raising the rates they control in March of 2022.
They were in the twos.
Huh?
They were in the twos.
They purchased.
Mortgage rates were in the twos.
When you go up, they went up from the twos to 22.
When they announced they were ending the program.
No, it was a gradual. I've got the schedule. Okay. I can send it. So
I can't believe you're saying that the mortgage-backed securities didn't impact mortgage rates.
No, of course. When they first started buying them, it absolutely did. There's, as I said, law of diminishing return.
Yes.
When they first started doing it, it had a massive impact. That impact it went down over time. And so
sure, it's like holding a basketball underwater.
Right. So the very end, when they were buying it,
we got inflation.
Yeah.
We got housing inflation because of it.
But I'm also saying that when they started buying them back during the crisis, it did not fully arrest home price declines. And they started buying in 2009. Prices did not bottom until 2012. So these things.
Do you think if they would have done what they did in 2020 in 2008, things would have turned out differently?
I don't know, but
they absolutely would have.
I think
mortgage forbearance for everybody that was delayed, fake low rates for anybody who wanted a mortgage. There would have been no foreclosure crisis in 2008
if they would have done. I see it as a timing thing, Ethan. I see that we've done it earlier this cycle. Okay. I was there when they did the first modification. I was there on the phone with the Fed when they told us to break contract law. I was there when we did all of that, those loan modifications and all of everything after the fact. Okay. So I kind of see it differently than what you're saying. And I see it as we've done what we did. It was even more egregious. Okay.
So you still see millions of foreclosures happening this cycle?
I don't necessarily see. Well, unfortunately, we probably will have millions of foreclosure. Millions. I mean, it's not like.
I think it peaked at like what, 2-3 million?
Yeah. I mean, we're already. So right now you've got 2 million default properties, according to Black Knight, who only tracks about 59% of the market. And they don't have the largest specialty servicer. So yeah, that's 2 million properties in default right now. That 1 million of those are FHA almost. And so, yeah. And so what's happening right now is as seriously delinquents are coming up. They're going to continue to come up. And what John has heard from some of his servicer pals is that they're expecting those workouts to fail at 50%, which is just insane. But yeah, we'll have foreclosure. It's going to take some time. We'll have a material population by Q2 2026.
So you see this happening again?
I don't know that we'll get to those levels. And then also what will happen is the state AGs will get involved. A lot of these are private note holders that have these properties now. They may not ever even show up on these things because, like Adam, they can't even. They're a good resource, but they don't have all the foreclosures because your judicial states. It's very hard for them to track those. They use public recordings, and so you have to file that Liz pendants. It depends on when you filed it, and so. Adam is a good data source, but it's also limited. But you can look at Black Knight right now, 2 million properties are delinquent and they've got 60% of the market. So yes, do I see foreclosures increasing? Do they get to the same level as last time? I mean, I honestly, I don't know. I don't care. I'll do that math as we're getting closer. But what I can say is that supply plus the headwinds of affordability, until that changes, I don't care what they try to do. I really don't. It's property taxes, insurance, electricity bills. These are all hitting. They're hitting even the top of the K. And the top of the K is saying, why do I need 5 properties? I really only need 4. Why haven't more people, why are people selling out in the Palisades to investors? Yeah, it's a real headache. But hey, if money doesn't matter, why are you selling? Because it doesn't make sense anymore, home ownership. And this is what I'm actually hearing from people who manage wealth, is that their clients are now shifting from real estate focus to focus on metals because it's a headache. So
yeah, there's not a good return for investors right now. I mean, investors reach out to me, I tell them I can't help them.
And they're a big chunk of the market. So if they can't transact,
maybe they're the 20% that isn't buying.
Well, it's more than 20% when you take in population, but yes, they are. There's still, some of them are still buying, especially in, lower cost markets. But, so yeah. Nashville specifically, like I haven't done a deep dive in a long time. But I think that, that supply situation, the low owner occupancy, as well as kind of just the labor headwinds with Medicaid. I mean, personally, I don't see good things. Now, will certain areas like Williamson, do better for a while? I think so. But what you're starting to see is like LPs, a lot of your doctors, dentists who were investing in multifamily, for instance, they're reaching out to me all the time. They're like, I lost everything, or none of my investments are paying out. And so and you can see this when you look at consumer sentiment, the top of the K, their sentiment is also coming down. And that wasn't always the case. And so I think what you're starting to see is issues on the top of the K, and obviously on the bottom, and that those are, that housing as an investment is just, it's not going to be something that people want to participate in for a good time. And Joe and Jane,
I hope you're right.
I mean, I don't know.
I think it would make it more bearable.
Yeah. But here's, you got to look at the politics of this. And, I'm a jack of all trades. I worked for a very well-known politician for many years. And what we see every day is not reality. And you got to look at the politics. You got to look at Mandami. You got to look at, kind of the fact that our Gen A or whatever ZA you want to call them are a lot more comfortable with things like socialism and things like this. And it's terrifying, right? But this is what the party knows. And so this is why they may say they cannot tell the asset holders you're going to get F'd. They can't tell them that. They can't. I mean, the phone calls will come flooding in. But that doesn't mean that doesn't mean it's not going to happen, because you have to go where the money is, and the money is not at the bottom of the K. So we need that money, because our debt situation, honestly, you look at that debt, you think you can just keep printing, but soon we're not going to be able to afford Social Security, things like that. And they can't print their way out of that. It's just, so I think that what's happened is that people look at what's happened before in the past 40 years and they don't put it into context of when the last time we had debt as a percentage of GDP. I would encourage people who are listening to this to check out somebody like Lacey Hunt, who is a very well-known economist, to understand the limited options we have when we get to this debt level. And so there's a lot of things to be watching. There is no one thing that's taking this market down. It is multiple things. Honestly, I think Nashville sits at the nexus of a lot of those things.
Yeah. And you don't think they can print, and you don't think it'll be wages. It's got to be price.
I think they'll.
Can't even be a combo. I hope
so, Ethan. I hope so. I would love that. I'm terrified for the people that I know that are in that bracket, like my, family members that have a pension and a home and are looking at that home as their wealth. Problem is, they're stuck because they may have a low rate, but if they go buy a house of like size,
they can't move.
They're losing every equity that they've built up.
Yeah.
So they're not stuck because of that low rate. They're stuck because of prices. And so, I worry a lot, but yeah, I'd love to see what you're saying. And the minute I see a real plan to get there, I'll be the first one talking about it. And that's why I dive into all of these numbers, because I truly, that would be, I said it in my last Substack, I vote for that. I vote for wage increases, please. I would love that.
But I think they'll come nominally. I don't think they'll come without inflation. So, but maybe I'm wrong. I don't know. It's a little bit, who knows? So.
Yeah. So we're kind of, to me, the bull case, I've seen no proof, and I need proof. And I can look at historically what MBS buying has done at different points. Why did MBS work, Ethan? Because you had a massive amount of people that got in the money for refis. Okay, that massive amount of people are not going to be in the money till we get below 3%. And so, and I've done that analysis at what interest rate, which we do have more over 6% now than we have had in a long time. But that's what I was working at PNC, and overnight, I was on a project there. Overnight, our volume went from like nothing to millions of pages of refis a day, just coming in hand over fist. So they extracted that while home prices were going up. Problem now, mortgage refi rejection rate is over 43%. Per Fed, their latest summary of consumer expectations and experiences. And so even if we get super low rates, a lot of people aren't going to be able to qualify because of student loans and student loan. And we don't even have all of them reporting to credit yet. There's millions of them that aren't actually reporting to credit yet because of the delay in servicers, because of the people on the save plan.
Are those homeowners or renters?
Both.
50-50?
And I'm sorry.
Are they 50-50?
I don't doubt it's 50-50. I mean, if you've got student loans. But the point is like those people, whether they're renting, if they're renting and those student loans are reporting delinquent, they can't buy a home. If they own a home and those student loans are over 270 days delinquent, they can't get a modification. That's a big deal. And so we are going to see delinquency rise from here, even if the labor market stays exactly where it is. Because of those increases to property taxes and insurance, we are going to see delinquencies increase. And we're running out of all of that loss mitigation we did during COVID, when people, a lot of them were able to go back to work and were not paying their mortgage and working. So
I think I could talk to you for 3 hours. I want to keep going, but I'm going to pause it here. I really hope we can talk again. I thoroughly enjoyed this discussion. I think philosophically we agree on a lot of the problems of what's happening. And I think that you do have a lot of compassion for people who feel stuck. And I admire that. And our solutions or our outcomes or our outviews are different in how we think it'll transpire. But I do appreciate your perspective, and I appreciate you taking my questions, and I appreciate that. So I just want to say thank you so much for your time. If you want me to put your Substack link and whatever links you want, I'll just put it in the description. I'll also pin a comment at the top of the YouTube and add it there too, so people can reach out to you. And again, thanks for the spirited conversation. Yeah. I genuinely hope we can do it again.
I appreciate the invite. I love talking to people with different perspectives. But what I would say as kind of a closing comment is,
please,
we looked at the prior cycle and everybody blamed it on subprime. If you were in that market, you knew better. That's not exactly what happened. Prime are the people that actually were the foreclosure crisis. And so I think that
because they lost their job.
There is no one reason. There's no one reason. It's multiple reasons, and it's a lot to track, and it's a lot to keep track of. But it's not going to be one reason, and so people looking for that are always are going to be disappointed, because it is a bunch of different reasons. And again, let's watch what the administration does.
Yep.
All right.
Awesome. Melody, you're awesome. Thanks for coming on. I'll pin those comments, and I really look forward to having this conversation again.
Sounds good, Ethan. Have a good day.
All right. We'll see you. Thanks.